Welcome to our deep dive on financial optimization. Specifically, why leaving tax advantage space unused is one of the biggest mistakes you can make. First, we'll set the stage and show you how to redirect your cash flow for maximum compounding. Then, we'll cover debt strategy, portfolio simplification, and relationship-based planning. Finally, we'll end with an action plan, quizzes, and a recap to lock this in. To begin, here's our roadmap. We'll start with a mindset shift toward tax efficiency over liquidity. Next, we will cover the critical move to reallocate contributions, followed by how to handle low-interest debt. After that, we'll simplify investments, coordinate housing and partnership goals, implement a step-by-step action plan using diagrams, test your understanding with quick quizzes, and conclude with a concise wrap-up. Before we proceed, please note this video is for educational purposes only and is not financial, tax, or legal advice. Tax laws and contribution limits change, and plan-specific rules vary, so consult your tax professional or plan administrator. As a reference point, we'll use commonly cited 2024 limits: $23,000 for 401k employee deferrals and $7,000 for Roth IRA contributions if under age 50. Verify current year limits for accuracy. Let's establish your position. You earn about $104,000 per year, with unusually low shared living costs, around $1,527 per month. You're already saving aggressively, about $3,300 per month into a taxable brokerage. The big opportunity is to redirect a substantial portion of that taxable contribution into tax-advantaged accounts first. This move creates immediate tax savings and stronger compounding. Now let's translate that into a concrete reallocation. Here's the key reallocation. Move from approximately $3,300 per month all into taxable to first funding your 401k at roughly $1,916.67 per month and your Roth IRA at approximately $583.33 per month. That totals around $2,500 per month into tax-advantaged accounts, leaving roughly $800 to continue investing in taxable. The 401k contribution lowers your taxable income, providing immediate tax savings, while the Roth IRA offers tax-free growth if rules are met. The remainder in taxable still preserves flexibility for medium-term goals. Let's quantify. Maxing the 401k at $23,000 per year equals about $1,916.67 per month. If your marginal federal rate is roughly 24%, the estimated federal tax saved on that deferral is approximately $5,520 annually, or about $460 per month. Roth IRA contributions of $7,000 per year are after tax and designed for tax-free growth if rules are followed. After prioritizing tax-advantaged accounts, your taxable brokerage receives around $9,600 per year, roughly $800 per month, compared with the previous $39,600 per year. Next, let's see why taxable accounts are not a substitute for tax-advantaged space. Comparing taxable and tax-advantaged accounts highlights the advantage of prioritizing 401k and Roth IRA. Taxable accounts offer flexibility, but dividends and realized gains are typically taxed each year. By contrast, 401k contributions lower your taxable income today, and Roth IRAs can deliver tax-free growth and qualified withdrawals. Over long horizons, that tax shield often compounds to a significant advantage, even if the underlying investments are identical. Now, let's test your understanding with a quick question. Question: which contribution generally provides the most immediate reduction to your current year tax bill? Options: A. Taxable brokerage contribution. B. 401k employee deferral. C. Roth IRA contribution. D. Holding more cash in checking. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. The 401k employee deferral. This contribution generally reduces your taxable income in the current year, providing immediate tax benefits. Roth IRA contributions do not reduce your current year taxable income, and taxable brokerage contributions have no upfront tax deduction. Given an average debt rate around 3.6%, history suggests long-run market returns may exceed that rate, making aggressive investing a rational priority. Maintain your scheduled debt payments to preserve credit health and optionality, but do not rush to prepay low-rate balances at the expense of retirement contributions. Revisit this decision periodically, especially if rates shift or your risk preferences change. Now let's reinforce this with a quick knowledge check. Question: if your average debt rate is around 3.6% and your long-term expected market return is higher, which is often the better default? Options: A. Aggressively prepay debt now. B. Split 50-50 without considering taxes. C. Prioritize maxing tax-advantaged investments while maintaining minimums. D. Stop investing entirely until debt is gone. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. When debt rates are low and fixed, prioritizing tax-advantaged investing while maintaining minimum payments can improve expected outcomes due to the return gap and tax benefits. This approach also maintains flexibility and preserves credit health. Your current mix of S&P 500 alongside total market funds is redundant because the S&P 500 is a large component of the total market. Simplify to a single total market fund or adopt a classic three-fund approach that includes U.S. stocks, international stocks, and bonds. In early accumulation, 100% total U.S. stock is a defensible choice if it aligns with your risk tolerance, with a plan to add international or bonds over time. Automation and consistency matter more than chasing minor optimizations. Here is your execution playbook. First, update your 401k deferral rate so you reach the annual maximum. Second, automate Roth IRA contributions at roughly $583 per month, considering a backdoor process if income disqualifies you. Third, standardize investments to a total market or three-fund structure across all accounts. Fourth, keep debt on autopay at the required minimums and revisit quarterly. Fifth, maintain an emergency fund of 3 to 6 months of expenses. Sixth, coordinate with your partner on a joint budget and unified plan. Seventh, schedule an annual review to reflect changes in IRS limits and your life. This journey diagram illustrates how each paycheck is routed. It starts at net pay, with pre-tax 401k contributions occurring at payroll, followed by automatic Roth IRA contributions of roughly $583 per month, and then the remaining cash flowing to taxable accounts at about $800 per month. Minimum debt payments at 3.6% continue consistently. Periodically, emergency fund top-ups occur, and a quarterly review checkpoint ensures your contributions track the plan and remain aligned with changing limits or goals. Moving forward, let's add relationship and housing coordination. As you approach marriage, establish clear, shared financial rules. Determine how much goes to retirement versus housing and when. Protect your retirement priorities so the down payment goal does not undercut tax-advantaged contributions in these crucial early years. Coordinate debt payments across both partners to avoid overlap and to optimize interest costs. Use shared budgeting tools, a contribution tracker, and scheduled review dates to maintain alignment. Here is a quick Markdown-style cheat sheet with priorities and simple allocations. First, max the 401k. Second, fund the Roth IRA. Third, invest the remaining funds in taxable accounts. For allocation, consider 100% total U.S. stock in the early stage, or use a three-fund mix with U.S. total market, international total market, and bonds. The monthly targets summarize the plan for quick reference. Next, we'll reinforce key points. These are the key messages. Unused, tax-advantaged space is a major, avoidable drag on long-term wealth. Max the 401k and Roth IRA before committing heavily to taxable investing. Maintain low-rate debt on autopay while prioritizing investing. Simplify your portfolio to avoid redundancy and reduce decisions. Align with your partner so your money flows frictionlessly according to a shared plan. In summary, redirect roughly $2,500 per month from taxable into your 401k and Roth IRA to capture immediate and long-term tax advantages. Expect meaningful federal tax savings from the 401k deferral, with our estimate around $5,520 annually at a 24% marginal rate. Keep low-rate debt on schedule and prioritize investment momentum. Use a simple, diversified core portfolio and coordinate with your partner early. Finally, let's close this out. Thanks for watching. If this was helpful, please like the video, share it with a friend, and subscribe for more. Tell us in the comments what tax move you are making this week. See you in the next one.